How's everybody doing today? So I'm live on a few different things, so I'm just going to kind of get started. And as people come in, I may repeat myself a little bit, but I'm going to get going. So the whole goal of the webinar today is to talk about really, the right way to invest in real estate today. It's a kind of ever changing market, and as we sit right now, you have interest rates somewhere on average, say around 7.5%, which is a significant change over the last like 7 to 8 days that we have a decent drop in interest rates. And I'll talk a little bit where I think it's going from here. But more importantly than anything, I always somewhat believe that real estate is a good place to invest. Even when rates are higher and inflation is high and kind of all this stuff is going on, I still really, really like real estate as an investment. So now is really a good time to talk about, where you can find the right investments more than anything. And I'm going to share some stats kind of that's going on in the market today and, where I see opportunity as we stand right now and somewhat as we're going to be over the next, 12 months. What we're seeing more than anything is, hold on 1 second, guys, I apologize. Sorry, there we go. What we see more than anything at this point now is a market in most markets, and I don't know where everybody's calling it from today. I know there's a lot of New York, New Jersey people on here, but the Northeast is significantly different than the other parts of the country. And I'm finding that out personally and in other ways. So if you're looking to invest in real estate, some of you, what you might want to be looking at is out of state. For those people on different platforms, I know you're in from different states, but you may be wanting looking at states, and I'm going to go over some of those statistics too. But let me get first to what's going on today. And if anybody wants some of the stats I'm going over on this webinar afterwards, just let me know, and I will send you everything. So just shoot me a message, and I will send everybody, kind of where I'm getting these stats from, what I'm coming up with. So home values have returned to historic highs, as most of you know, right? So data from Zillow is showing us now that pretty much between 2012 and 2020, which was COVID pandemic, that values grew at a pretty even pace. And then in 2022, they kind of peaked. Nationwide, we were about $348,000. And again, regionally, depending on where you are statewide, that changes. This was followed by a small dip in the average prices last year of about, I would say, 3 to 4%, where prices were down last year around January, February, March. And then subsequently, they've been up ever since. And now we're back at record highs. The average in the country is about 350,000, but we're about 3 to 5% higher than we were at the peak of COVID pandemic as far as home prices go. So that's a good thing if you have a house and you've been gaining equity. It's a bad thing if you're looking to buy a house, but that's kind of where we are right now. The biggest problem, and this is a kind of alarming stat, is that I'm going to go back to 2012 again, because that was a post crash market where the market had kind of normalized and we got back to normal buying. And it was a normal real estate market where there was somewhat of normal inventory. Right now we are at about 4 million homes listed across the country, which is a significant shortage. And that's where the problem's coming in. In 2012, when we were in a healthy market where there was normal listings and normal prices and normal interest rates and kind of everything was about average, we were at about 12 million. So we're only a third of where we really were at a healthy market. In 2015 and 2016, we were somewhere around 7 to 8 million. But we've been dealing with a shortage since about 2019. But now it's a really significant shortage, which is really where the problem lies with home prices. So, I want to kind of
significant shortage.
So I want to start here. I want to just talk about where the rates are today and where I feel like they're going, right? So rates today are about 7.4%. There were two reports that were released in the last 30 days, one by Goldman Sachs and one by Freddie Mac, that said they believed that interest rates would average out somewhere around 7.5% for next year. I believe it's going to be a little bit lower than that. I think they put that report out before what we saw happen in the last week. And now let me just go over, for those who don't know what happened in the last 10 days, inflation has seemed to peak based on the numbers. The numbers that I'm speaking about as consumer spending was down for the first time since before they really started raising interest rates, and unemployment was up, and that jobs number, the amount of jobs that were added to the market last quarter, was down for the first time in a very, very long period of time. So those are the telltale signs that inflation has peaked. Historically, after interest rate raises, the Fed waited at least 9 months from when they stopped raising interest rates to lower interest rates. So if we look at that number, we will start seeing interest rates being reduced if it goes by historical numbers in May or June of 2024. So second quarter. What I believe you will see is you will see a drop in the interest rates over the next 4 to 6 weeks, maybe to around the 7% range. Then we will see some kind of drift back up in January, February, and then ultimately second quarter of next year, I believe it will land somewhere in the high sixes, maybe mid sixes as a low. But that's probably where we're going to end up. And I think for the year of 2024, which is what we're looking at this point, since we're in the middle of November, you're going to end up somewhere around 7% as an average for an interest rate next year, which is much better than where we were. And for those who didn't see it or weren't necessarily paying attention anymore because they're fed up, which I understand, we were somewhere around an average of 8% over the last 6 to 8 weeks, which is really significantly hurting buying power in the market. You're finally starting to see it take impact. And for those of you who don't know me, I'm in the mortgage business. I run a mortgage business, and we've seen a pretty huge drop off in applications. But what I am seeing, and I think this is significant for everybody on this phone call, is we're starting to see a lot more cash out refinances, which is telling you that people have gotten to the point where they're house rich but cash poor, where they have a significant amount of equity in their homes but they don't have cash in their bank account. So that really should lead to increased listings and should lead to movement in the market. And I'll get to some of the stats on that now because I think it's relevant. Listings are down, but over the last September and October, they were up 3%, which is the most significant raise they've had, period, in 2023. So they were actually up in September, October. So that's a really, really good sign. We're starting to see some market movement, right? So, that's the first time we're kind of headed to where we want to be as far as this market goes. Now I'm going to try to get into some buying strategies that I would be looking at. And if anybody has any questions, feel free to put them back into the chat at any point, and I'll try to answer them as I go. So I'm going to talk about now kind of markets I would buy in. Now, I want to preface this with, I'd like to use an average of a 7% interest rate to talk about my buying strategies. That's where between 6.75 and 7% is where I feel we're back at a reasonable interest rate to buy, where it's not really hurting your ability to buy a home. So I'm going to use that as the benchmark rate where we're looking at these investment strategies. And I really truly believe that you will see those rates in the next few months, and then again on average for 2024. So where I'm seeing buying opportunities now and selling opportunities. So I'll give you an example. I'm selling a property in Florida right now that was an Airbnb property that's just become a property that wasn't the Airbnb market where this is kind of dried up. When I listed the property, me being from New York and living in New Jersey, I figured that I listed it pretty competitively. I figured I'd have multiple offers and it would fly off the market. And I listed it at a very competitive price. I ended up getting asking price for it, but it took 6 weeks. I had a bunch of lowball offers. I had people trying to bargain. And so it's a normal market there, right? It was completely different than in New Jersey, where I listed a property here and there was multiple offers immediately on it. The other thing I'm starting to see in New York and New Jersey, which I think is relevant, or in the Northeast, and relevant to mention, is that I recently listed a property for rental. Now, rent is way up for anybody that knows what's going on in the Northeast, but it took me a few weeks to just start getting applications on it. So the reason I'm bringing that up is I think that we're at a point in the market where everything is higher priced and people have less cash available to do anything, right? So, that's significant in this market. The reason I bring up Florida and other markets is where I'm starting to see opportunity, that I believe is opportunity, is in markets where they're starting to get more inventory because houses are sitting on the market longer, and homes are really selling for what they're worth. and you're going to start to see more inventory there. The reason I think there's an opportunity there, if you use an average interest rate of 7% or a little bit lower, is because you're going to get a house that's not going to drop in value much more, but you're going to get it in a market that's kind of bottomed out, right? And when I say bottomed out, I believe that in most markets, we're at a place right now where the average price of where it is kind of where it's going to be. And for markets that are really, really busy, like New Jersey, I think the houses you see sitting on the market now, and there are some inventory out there that's sitting, those prices are priced too high, and everything else that's moving is kind of at a price where it's at its value. So if you can find a property in a market that the house is really at its true value, because the market's moving a little bit slower, I feel right now that's a buying opportunity, because when interest rates do drop and they get to 6.5% and they eventually get back into the fives, and I believe that will happen over the next 12 to 18 months, that you'll see rates back in the high fives, low sixes, there will be a feeding frenzy for people buying houses. And I think most people are saying this, but when that happens, values will then increase again. So you can find a property in a market where the properties have bottomed out and we have kind of an average price point again. I think it's a buying opportunity. Now, I'm going to talk a little bit about where those markets are, right? Just based off of what we're seeing. For those who are in New Jersey or Vermont or Maine, those were the highest increases in prices in homes in the whole entire country this year. They were 7 to 8% up. So if you are in those markets and you're on this call, you're in an abnormal market, right? Which is kind of crazy to think of, that New Jersey was up 8% this year. It's tied for the highest in the country at this moment. States like Arizona, Idaho, Nevada, New York, even New York, when you look at the whole state, Texas, and Florida were really only up. As a matter of fact, Texas and Nevada and Idaho were actually down over 2% right now. Florida was only up 3% as a state. And there's some other states that that we frequent that are in the Midwest, that Michigan, Iowa, even a state like Arizona, stuff was only up between 1% and 3%. So if you look at the rest of the country, by the way, 1% to 3% is like a national average per year what homes increase. So those markets are all back to normal. So if we're in an abnormal market like Texas, where we're down 1% to 3%, or New Jersey, where we're up 8%, I believe that you will see some attrition in New Jersey, where you see prices come down for a little while until rates decrease at some point over the next quarter. And in a state like Texas, there is a buying opportunity there. In a state like Florida, there is a buying opportunity there. In a state like Pennsylvania or Connecticut, which is close to us, where prices were only up between 1% and 3%, those are normal averages. Out of state owns long-term rental properties and short-term rental properties. I have a bunch of Airbnbs. Now, if you would have asked me the question in 2022, what my best, I'm doing amazing. If you would ask my best investments are today, they're my long-term rental properties. So the market is flip-flop.